Well, we know Nvidia is playing a huge role in markets right now, but could it impact the Fed as well? Well, one analyst sees the Nvidia-driven hype around artificial intelligence as a possible bellwether for rate hikes. More investment means more productivity, and more productivity could mean more tightening. Investors will definitely be looking to Jackson Hole, Wyoming for clues about tightening, as the Federal Reserve Chair Jerome Powell will take the mic there tomorrow morning. Now, we've seen the 10-year Treasury yield pull back from this week's highs over the last couple of days, but could Powell's speech send it roaring back? Joining me now is Luis Alvarado, Wells Fargo Global Investment Strategist. Good to see you, Luis. So what is your take here? How much of this, obviously, when you have this rally that's very Nvidia and generative AI driven, how much of this is going to be a reality check when we hear from the Fed?
Yeah, thank you, Rachelle. I think the Chair Powell is going to be pretty much keeping the same message that he's been keeping all along, trying to stay consistent. And the Fed is going to remain pretty much with a hawkish rhetoric. In regards to the effects of yields, like you mentioned, I think there's going to be some possibility that we have pullbacks, volatility. There's definitely a lot of information in the markets that are being digested right now, and that's definitely going to affect yields.
And is there anything you think the Fed could say that would shock the market? Because, I mean, as you mentioned there, we're expecting this hawkish tone.
Yes, the hawkish tone, I think, is going to be consistent with what the market is expecting. I think the big information that we're all expecting in regards to meetings, the Fed is going to keep those for the meeting in September, pretty much assessing what's been happening with the economy, with all the incoming data in regards to inflation and unemployment. Most likely what we're going to receive from Jackson Hole, which is a big difference from last year, of course, is mostly looking for 2024, what they can tell us about quantitative tightening, whether they believe pretty much the metrics that they follow in regards to inflation are telling them, and the fact that they're going to remain cautious. They would rather pretty much err on the side, most likely, of, not allowing inflation to come down as they want to see it, and they will continue pretty much with this sort of tightening policy. They're really concerned that if they let the pedal off the gas too soon, too fast, they're going to get something that we experienced back in the late 70s and early 80s.
So for people who are sort of looking at what we've seen, especially with the 5 and the 10-year, still up over 11% year to date, if they're wondering how to play the bond yield market or the fixed income market at this point, when you know that interest rates are still going to stay higher for longer, how should they approach this?
Yeah, and this is something that we've been advising our clients for quite some time. We believe there's definitely good opportunities in the short end of the curve, and anything that is very short-term dated, 3-month T-bills, money markets, CDs, great opportunity for clients and investors to park their money there and take advantage of obviously this higher rates that we haven't seen in more than 15 years. At the same time, it's also important for investors to start thinking a little bit more longer term. And that's why we also advise them to also invest in the long end of the curve, kind of having this barbell approach. With a barbell approach, pretty much the long end of the curve, anytime you see yields in the 10 and 30 year above 4%, we believe is a great opportunity for investors to add that duration, being able to lock in those attractive rates, because eventually we do expect the Fed to cut rates to aid the economy, because we all know that an economic slowdown or recession is going to come. We just don't know when. But we're starting to see some signs, and it's a good opportunity for those investors to then position in the long end as well, awaiting the time when rates will go down, and that will definitely make those bonds appreciate in price.